Welcome back to the IEA's podcast, Everything Energy. I'm Dan Hewitt. This week we're looking at the 2026 World Energy Investment Report. The world is living through its second energy crisis in just 5 years, this time triggered by the effective closure of the Strait of Hormuz. But how is this latest crisis changing the way the world invests in energy? The World Energy Investment Report tracks the big investment trends across the energy sector, and it shows how priorities and evaluation of risk are changing. Countries are already diversifying their trade routes and turning towards domestic energy. But what impact could today's supply shock have on future investment plans? Joining me from the IEA are Kirsten Smith, an energy investment analyst, and Cecilia Tam, head of the Energy Investment Unit. Okay, Kirsten and Cecilia, thank you both for joining us today. Now, you were both involved in the World Energy Investment Report. So let's start by reminding ourselves the big questions this report is trying to answer. And Cecilia, let's start with you.
Thanks very much. So the World Energy Investment Report is the IEA's annual publication that tracks all of the capital flows going into the energy sector. This year's edition was particularly key in the sense that we were looking at how the current energy crisis was impacting investments into the energy sector. We saw major changes as a result of the energy crisis with how countries and different companies were prioritizing energy investments. Many of these changes we saw were already being implemented many years ago with a significant shift away from investing particularly in oil and other fossil fuels, and more in towards investments into renewables, into grids, as well as into end-use energy efficiency and electrification. The report is really looking at how different markets, depending on their resources, are prioritizing different types of investments into the energy sector.
Now, are there any trends about the way that the world invests in energy during a crisis? We obviously saw a recent crisis in 2022 with the Russian invasion of Ukraine. But what happens to the way, as I said, the world spends its money during a crisis?
When we looked back at the 2022 crisis, what we noticed was there started to be a few strategies that emerged, one of which was looking towards some more domestic resources. So things like renewables that can be anywhere in the world. You can build solar and wind to different degrees of how efficient they are, but they are domestic sources of energy. We also looked at energy efficiency is something that you can deploy anywhere, again, to reduce the actual amount of energy you use. And then other sources of energy that perhaps are less tied to world prices, such as oil and gas are world commodity markets. So how do you insulate your domestic consumers from some of those volatile price spikes?
Right, let's turn to the figures themselves. Let's remind ourselves of the big figure about how much the world is investing in energy, and then we'll break it down a bit further. So, Cecilia, what are the big figures?
So this year, in 2026, we're estimating that the world will spend $3.4 trillion in the energy sector. 2.2 trillion of that will go towards a mix of renewables, grids, storage, low emissions fuels, nuclear, efficiency, and electrification. And about 1.2 trillion will be invested in fossil fuels for oil, natural gas, and coal.
Okay, I think the way to do this is let's split it up a little bit. Let's start with fossil fuels. Why don't we begin with oil? What have high oil prices meant for energy investment in oil?
Although we revised down slightly the upstream oil investment for 2026, our expected investment there, it is a little too early to see what will play out as these oil and gas companies have to look at repairing infrastructure that was potentially damaged, looking at alternative routes for moving oil to markets, and continuing on with previous projects that the final investment decision was made in previous years, and those projects are either beginning construction or already under construction. So higher impact of oil prices can be more profitable for these companies and spur new investment, but it really depends on the region and the ability for different resources to bring new barrels to market quickly.
Okay, let's turn to LNG, liquefied natural gas. The conflict has halted exports of LNG through the Strait, but what does the data tell us about overall investment in LNG right now?
So in the LNG markets, we really saw over the last decade, the price of natural gas has really fallen quite substantially due to the revolutions in shale and tight gas production in the United States. Because the price of gas has declined so much, we've seen a lot more investment in energy export infrastructure in order to be able to send that LNG to other places in the world that don't have that domestic source of production. And in 2025, we actually saw one of the biggest years of investment in LNG export infrastructure coming to market in order to, again, send that gas to other regions that don't necessarily produce it. But again, these projects are so big that they take years to come to market. And so we've been waiting a little bit for really a supply glut to hit the market. And that may actually be pushed off or delayed a little bit because of the current crisis and perhaps a change in perception from some of these importing regions that have now seen, again, price spikes in the market for the second time in 5 years.
So just to tie up fossil fuels, I want to ask you about coal. Have countries, in fact, turned back towards coal because perhaps it's an energy supply that hasn't faced a disruption that other energy sources have?
You know, when we're looking at coal, we really need to look at what is happening in Asia and how the current crisis has impacted these countries. And in 2026, that we're forecasting that coal will hit its highest spending level in the last decade. And a lot of this is really determined by spending for coal supply in China, to a little bit of a lesser degree also in India. And these markets, which are very much fossil fuel, oil or gas import dependent, have been investing quite a bit in coal supply as well as coal-fired power plants for energy security concerns. In Southeast Asia, a number of these markets are also asking themselves around how they can best respond in the longer term to enhancing energy security. As Kirsten mentioned, these markets, which we were hoping to receive a large part of that surplus gas, have seen big price spikes, which is leading them to reevaluate their plans for natural gas as a transition fuel, and are reconsidering some of the coal transition policies or strategies that they were considering in the past because of these concerns around energy security.
Okay, let's move to renewables. Because of the disruptions we've seen to trade flows, I guess perhaps people have been asking themselves if that has led to a boost in renewables. But what does the data show us? Has more money been flowing into renewable energy?
Well, over the last decade, we've seen more and more investment flow into low emissions power sources and renewable power sources every year. Now that trend has been increasing to the point where we've seen in 2024, I believe we hit the highest level of investment that we had seen. We've now come down slightly in the past 2 years, but this has been because of a couple of different factors, less related to the actual deployment, but more the continued declining costs for some of these technologies, as well as some policy changes in some major markets, including China and the United States. So in 2026, we actually saw $665 billion continue to flow into the renewables investment globally. And solar, we actually saw $1 billion a day of investment to deploy solar around the world. We've continued to see the majority of power sector investment really flow into renewables, with over 70% of investment in the power sector flowing into low emissions power sources. So we're really continuing, even though we've seen a little bit of a dip in the last 2 years in overall investment, we're continuing to see strong deployment of renewables in the energy system globally.
Okay, in lots of our podcasts, we've spoken about the age of electricity, but what does the data show us? What does the data show us about how much money is being spent, not only on electrification, but on the infrastructure that surrounds us, for example, grids and batteries?
Absolutely. So over the past decade, we've really seen the amount of capital investment that goes into both the power system itself, but also the electrification of end uses increase quite substantially. About a decade ago, we were spending about 38%, almost 40% of our total capital investments on both the power system as well as electrification. And in 2026, we expect that to be 58% of the total energy investment going into the electrification and the age of electricity, really. And this has been a trend that has really been driven by renewables deployment in previous years. But in 2026 and over the past few years, we've started to see more of an uptick in grids and storage, which are really key enabling systems for further renewables deployment in the power system. So in grids, in 2026, we expect over $500 billion to be spent. Now, some of that is definitely increased deployment, which is a great thing that we've been talking about needing to see in the system for a few years now. But it's also as a result of higher costs of some key equipment, such as transformers and cables. For 2026, we also expect to spend about $100 billion on battery storage systems. And this is really going to be a key enabler for continued renewables deployment as the age of electricity continues going forward.
So we've seen these big disruptions to trade flows, but perhaps that raises a bigger question about countries' relationship with energy that's come from domestic sources, and perhaps there's an anxiety about importing energy from other countries rather than producing it themselves.
Definitely so. I think if you look at the investment strategy of different countries, particularly major oil and gas importing countries, over time we've seen a tremendous shift towards prioritizing what we would consider domestic resources. So that's spending for renewables, for grids, for storage, but also at the end use side, spending for energy efficiency, as well as for electrification. So in 2026, we anticipate around $700 billion to be spent in both electrification and energy efficiency. Over the last decade or so, the amount going towards electrification has really grown very sharply thanks to major cost declines for electric vehicles, but also a big push for governments towards heat pumps as well, and for efficient cooling systems.
And to add to Cecilia's point on efficiency, when you look back at the period of previous energy crises, this is really where those strong government policies around more energy efficiency in end uses were really developed and pushed forward. If you look back at the 70s, this is when the fuel economy standards were introduced to reduce the amount of oil used for vehicle transport. And these policies really are an underlying stabilizing force that reducing the amount of energy you actually demand is one of the most stable ways to insulate yourself from energy fuel price spikes.
And have we seen any new projects to circumnavigate the Strait of Hormuz? Because we know that has now been pretty much completely blocked since February.
We haven't seen any announcements of new projects to have alternative routes to market where you don't have to go through the Strait of Hormuz. But again, this is on different importing regions' mind because so many of the barrels that come out of the Middle East pass through that strait. So if we look at over the past 5 years, the amount of barrels that come out of the Middle East, about 65% of them have to pass through that strait. And the Middle East also produces some of the most low-cost barrels in the world. So as an importing region, this is a very important region in order to secure oil supplies to use in your own domestic economy.
Okay, so the report makes some interesting points about innovation. And if it hadn't been for innovation in the energy sector, then prices would be a lot higher. So what can you tell us about the impact of energy innovation?
We've seen costs for things like electric vehicles, battery energy storage systems, and solar panels fall by more than 75%. We've seen cost declines in wind as well as upstream oil and gas fall by about 25%. And those huge savings are really the result of spending on R&D, on innovation, and on scaling up of manufacturing. If we were to take the 2015 costs of these technologies and apply them to what we invest in 2026, we would have seen total investments in the energy sector reach nearly $6 trillion compared to the $3.4 trillion. So, those investments into innovation have really had major payoffs into the energy sector overall.
After the last energy crisis, the world saw big spikes in inflation. Now, if something similar happens again now, what could that mean for the amount of money that is invested in energy? And I guess by that I mean, what does that mean for projects that have already been announced or potentially future projects as well?
Yes, so this is definitely something that people are watching. First of all, interest rates. We haven't seen increases in announced rates yet. However, we have already started to see bond yields of countries increase, which means higher cost of financing for these types of projects. But in particular, clean energy projects are more highly affected by the higher cost of financing. So this is a stronger disadvantage for things like solar and wind. But also, if we're looking at the types of projects that may be more disadvantaged, would also be projects in countries in emerging markets and developing economies where the cost of financing is already quite high.
So just lastly, there's obviously been a shift in a way that perhaps countries in the world thinks about energy security, and that comes with a cost. So have we got a sense of how much extra perhaps countries are going to need to spend and where potentially that money is going to come from?
So if you think about the cost of energy security for consumers, you're potentially either paying it upfront or later on when there are price spikes potentially from things like the current crisis that we've been seeing. There's different ways to insulate your consumers and your markets from some of these price spikes. I think when we look at oil markets, the way that countries have done it historically is by investing in oil stocks. If we look at that from an energy investment perspective, that's the infrastructure that is actually built to store those oil barrels for future energy security needs. But there is a cost to having storage for extra barrels in case there's a shortage for domestic consumption. That's one strategy. But if we just talk about the overall cost, will this cost the end consumer more? It's not necessarily the case that for all consumers, they're not willing to pay a bit of a premium to make sure that they have the energy available.
And I think if you look at what's happening in industry amongst corporates, this is the consumer class that in many times is most willing to pay more for secure power because they're going to be much more sensitive to what's impacting their revenue streams. And they may be also able to absorb some of these higher costs to get 24/7 power. And I think if you look at just what's been happening with data centers, that's a very good example of how you see a growing part of the electricity market looking to source reliable power, they're willing to pay more for that. And it's clearly having impacts on the investment numbers.
Okay, Kirsten Smith and Cecilia Tam, thank you so much for joining us today.
Thank you.
Thank you.